Hello, class. This is lecture 22 for History 102. And we left off last time. We were talking about the election of 1928 that Herbert Hoover defeated Al Smith. So what we want to do next is we're going to be working right up to the crash of the stock market in 1929 and the Great Depression. But there are several reasons why this horrible event will happen and why the economy will collapse. Now, first of all, one big problem that the U.S. economy suffered through in the mid to late 20s when all this happens is we were producing way more goods than consumers in the United States could possibly buy. So what that means is you need to be able to export goods to sell them in other markets when you overproduce. But unfortunately, thanks to Fordney-McCumber tariff bill that was passed under the Harding administration, where they consistently increased tariffs, we basically shut out our main markets in Europe because of trade wars and high tariffs against the Europeans. So they weren't buying our goods. They were too expensive. Plus, American workers weren't making enough to buy the goods they were even producing. So U.S. consumers were sort of handcuffed because they didn't have enough money. Now, one of the reasons why this occurs is big business was greedy. During the 1920s, thanks to mainly the innovation that Henry Ford introduced of assembly line production, and many items start to be produced that way, productivity in the United States shot through the roof, meaning workers were producing much more than they had in the past. And another factor in all this that I'll remind you of, the 1920s is Prohibition. So workers weren't drinking on the job like they may have been in the past, which was one of the reasons that the temperance movement argued for this. So productivity during the 1920s increased by 43%, which is unheard of. The only other decade in American history where productivity increased more than 43% was the 1990s. And that's the decade when computer technology was applied to all aspects of American business. So, when productivity goes up by that amount, typically, if economic factors are being managed correctly, wages should go up also. But during the decade of the 1920s, wages only increased by 11%. So you have productivity increasing by 43%, going on a plane like this, wages way down here at this. What's in between productivity up here and wages down there to big business America? Profit. So they were taking way too much profit. They should have been giving some of it back to the workers so the workers could buy the products they were producing. So this was a big factor causing the crash in 29, as we'll find out. Another problem was unstable European economies. Besides the trade war we were in, thanks to Fordney-McCumber, they were still reeling from World War I, attempting to rebuild. And then remember that crazy debt merry-go-round that we talked about last time, where we insisted on collecting the debt, and then they insist upon the Germans paying the war reparations from the Treaty of Versailles. And long before our market crashed, the German economy crashed. And also, Another big factor in America was agriculture and farmers. Farmers during World War I were in their heyday because we were basically feeding our European allies. So they're selling every speck of grain they can produce. Now, to give an example, in the height of World War I, wheat was selling for $3 a bushel. Now, I know that doesn't mean much to anybody, but these are just figures to give you a comparison. Due to the fact that Europeans all came back online and started producing their own food once the war was over, and due to high tariffs on top of it, wheat dropped from $3 a bushel to in the mid-20s down to 57 cents a bushel. So farmers were struggling to make ends meet because many of them thought that, this heyday, so to speak, was never going to end. So during World War I and at the beginning of the 1920s, many farmers in America went into debt to buy new farming equipment because mechanized farming equipment had really excelled. So brand new tractors, reapers, harvesters, and so forth became available. Farmers invested in those. But then when the grain market crashes in the mid-20s, they're in big trouble. So the Great Depression was felt by farmers first, but typically any economic downturn hits the farmers first. So we had the agricultural decline. Then the distribution of wealth was way out of whack again, where the wealthy, industrialists were reaping in all these profits, and the average American was barely getting a raise. So what the banks and industrialists came up with to supposedly solve this gap was this is the first time in American history the idea of installment credit became available to people like you and I. Now, we take this for granted today. When you buy a brand new car, very few people pay cash for a brand new car. You get a loan and you pay it off month by month. That's what installment credit is. But previously, it didn't really exist because Americans could afford what they needed to buy. So this was their solution, and all that did was put your average person like you and I into debt. So all of these things put together are going to set up disaster in 1929. But now let's talk a little bit more about what's really going to lead to the stock market crash and where we can understand what's going on with the market. During the 1920s, another thing that changed is some average Americans, especially middle class, became infatuated with the stock market. Previously in American history, only really wealthy people dabbled in the stock market and bought and sold stock and so forth. Now, all of a sudden, middle class America becomes aware of this, starts investing, and because more and more money is being poured into the market, it's going to start rising tremendously. Now, one problem also underlying all this is the stock market, up to this point in American history, is basically completely unregulated by the government. Regulation of the stock market's not going to take place until the 1930s, and it'll be part of New Deal reforms and legislation. So, people are becoming crazed by the market. Stock prices start appearing on the front pages of newspapers instead of buried way back in the business sections. Stock ticker machines that used to spit out little thin pieces of paper with stock prices on them. Today, if you watch a financial channel, that's what scrolls across the bottom. Back in the old days, that used to come out of a globe machine with this thin strip of paper, and people used to watch it and see what stocks were doing by the minute. And it was all sent to different places through telephone lines. So stock tickers were everywhere. They'd have them in barber shops to bring people in, different stores and so forth to attract customers so they could check on their stock because they obviously couldn't turn on television or look on their phones like today. So America becomes infatuated with this. And one other thing, little note, a trivia. I'm sure you've all heard of ticker tape parades. Ticker tape parades were in New York City especially, where they'd save up these little strips of paper that come out of these machines, and they'd have miles of this stuff piling up. They'd save it for a big celebration, a parade in New York City where they're honoring somebody, and they'd dump boxes full of it out of the windows of tall buildings in New York City as the parade went by, and it streamed down. That's where that name came from. Today, you can't have any ticker tape parades because there is no ticker tape. I suppose you could throw shredded paper out the window, but they don't do that. So, to give you an idea here, as far as what the market's going to do starting in the mid-20s, the total value of the New York Stock Exchange in 1925 was $27 billion. Now, by early 1929, that fateful year, the stock market had increased tremendously in this period from 1925, and the market was worth totally $67 billion, up from $27 billion in 1925. Now, another big problem that occurs with the stock market and just, regular naive investors, people think there's no end to this increase in the market. So a lot of people really start to act foolishly. And banks and big companies start to offer loans to people so they could go and buy stock. Buying stock on a loan is what's known as buying stock on margin. And here's how it works. You'd get a loan, you'd have to put up collateral, like perhaps your house, to back up the loan. A company or a bank would loan you money. You would go and buy stock with it, but you would have to report to your lender what stock you purchased. Now, the big game plan is, if everything goes correctly, that stock you bought on with a loan or on margin would increase dramatically. Then you'd sell it off. You'd have enough money to pay back the loan plus interest, plus you'd make a profit as an individual. That's when things are going well. The problem is, if the stock market starts to go down and the market goes down below a certain level of the price where you bought the stock. So let's say, just hypothetically speaking, you bought some stock in General Electric and you paid $10 a share for it, and you did it on margin. Your loan might say, if that General Electric stock drops below $8 a share, the lender could then call in the margin, meaning you would have to sell the stock, pay back the loan, and then you'd have to pay back what wasn't covered by the sale of your stock because you're selling it less than what you paid for, plus you got interest. That's what a margin call was. This will become very important here in the crash. So a lot of average people foolishly were buying stock on margin. Now, if I can ever give you one piece of advice for the rest of your life, never, ever buy stock on margin. It's way too risky of an adventure. You can still do it today. If I were you, I would never, ever do it. So, what's going to happen? 1929 is going to continue to be a very lucrative year. And by the time midsummer rolls around, the New York Stock Exchange value had increased from $67 billion to $80 billion. So to a lot of people, they thought, this is great. It's never going to end. I'm just making money hand over fist. So they're buying more stock on margin. Now, the big warning should have came in 1927 when we had a mild recession. Now we're not calling them panics anymore. We had a mild recession because the sale of durable goods, which is like refrigerators, cars, things like that, declined, and housing starts also went down. Now, this was an indicator of perhaps bad things to come in the future, and what business should have done is they should have done a combination of lowering their prices of like refrigerators and slightly increasing the wages of the workers making them so they could afford to buy them. But all that happened was instead, the government lowered interest rates, and people just took this opportunity of lower interest rates to buy more stock. So it was a foolish move. So what's going to happen here is, every 1929 steamrolling along until we get into later in October of 1929. And what's happening in October, it's when companies report their third quarter earnings. Companies report their earnings by quarters. Right now, what's going on, companies are reporting their first quarter earnings in 2020, and obviously they're dismal thanks to having to shut down most everything. So we divide it up into quarters. So September 30th is the end of the third quarter. Companies report that, and then also that gives them a pretty good opportunity to report on how they're going to meet their yearly target at the end of the fourth quarter, how they've done through three quarters. So unfortunately, these third quarter reports are horrendous. RCA and Westinghouse, two of the biggest companies in America at the point, report that their third quarter earnings were so dismal that they're going to have to lay workers off and close some plants. Europe is in the same position, and their economy is faltering. So on October 24th, 1929, when all these horrible reports come out, the stock market is going to start to decline dramatically. That day is known as Black Thursday, October 24th, 1929. On that day, those two major companies I mentioned before, RCA and Westinghouse, lost 50% of their value, which then started to trigger margin calls. If you'd bought RCA and Westinghouse with a loan on margin and it dropped below that requirement, then you had to sell the stock that day, which magnified things. So on Friday, October 25th, investors are very, very nervous. But what's going to happen here is the stock market will sort of settle out and, in fact, increase just a little bit the next day. So a lot of investors and whatnot and experts are going, phew, that was close. This was a one bad day, for sure, the day before, but we'll get through this. So they go into the weekend with some cautious optimism. So on Monday, October 28th, the stock market opens again, and it's steady, and once again it goes up a little bit. Now, what people don't realize, the reason why the stock market steadied and actually increased a little bit is because of one person, the most wealthiest person in the world at the time, J.P. Morgan. He single-handedly was buying up stock, trying to stabilize the market and increase confidence. He did this for 2 days, Friday the 25th, Monday the 28th. At the end of the day on the 28th, when he figured out he's basically the only one buying stock, he had to make a very difficult decision. And what he decided, obviously, was he can't do this every day. So on Tuesday, October 29th, 1929, that day that will live in infamy, Black Tuesday, the stock market will crash. J.P. Morgan will sell, and that will trigger all sorts of margin calls and other investors to bail out. And by the end of the day, the market had dropped back to prices they hadn't seen since 1927 in one single day. So this is the beginning of the Great Depression. By the end of 1929, the market had lost 50% of its value and was down to being worth only $40 billion. And in the summer of 29, it had been worth $80 billion. This will just continue year after year because now we're going to be mired in the Great Depression. By 1932, which is going to be the height of the Great Depression, the stock market had dropped by 80% off its 1929 highs. Unemployment is going to continue to skyrocket. By 1933, which we'll be talking about because that's, after an election year, unemployment will peak out where about 12 million people will be unemployed in America, and that will translate to a 25% unemployment rate in the United States. Now, this is going to be a slow, steady increase from 29 to 1933, but still, that's when it's going to reach its peak. Now, also, we can see how bad it is by 1932, 1933. The steel industry, which was the backbone of American industry at the time, is operating at just 12% of capacity, which basically means they just are keeping the blast furnaces going because you can't completely shut them down. And the gross national product of 1932 was only 67% of what it had been in 1929. A 1/3 decrease. That never, ever happens. So this is how severe the Great Depression was. So that's where we're going to call it quits for this lecture, because next lecture we'll pick up with what President Hoover doesn't do with all this horrible economic conditions, and that'll lead us right into the election of 1932. So I'm going to take a little break. I'll be back momentarily to talk about President Hoover. See you soon.